Hi, I'm Jimmy. In this video, we're looking at the top 5 dividend stocks that appear like they could also be trading at a discount to their intrinsic value. So we're looking at dividend stocks from different industries and dividends that range from about 3 or 4% to north of 10%. That being said, let's kick it off with our first dividend stock, which is Exxon Mobile. By the way, this is the Investors Grow website. If you'd like to get access to it, I will leave a link in the description below. Now let's get back to Exxon. So Exxon Mobil is one of the largest oil and gas companies in the world. They got a market cap of about $500 billion. Generally, what they do is a lot of exploration and production. Basically, they pull oil and gas out of the ground. So when we jump over and look at their fair value using discounted free cash flow, we can see that we get a fair value of about $146 per share. This is using analyst estimates to come up with what the fair value would be. Using those analyst estimates for free cash flow, fair value is 146. The current price is about $113 a share. That's more than a 20% potential upside. So now when we jump over to the dividend history section of the website, well, we can see that when we look at the past 10 years, ExxonMobil has done a decent job of increasing their dividends. But when we go over to 20 years, toggling over to 20 years, well, they've really increased consistently for the past 20 years, increased their dividend by a decent amount. Then when we jump over to their net income coverage, by the way, net income coverage is does their profit cover the dividends that they're paying? The higher, the better. And we can see with ExxonMobil over the past 20 years, outside of that pesky 2020 area, their profits have consistently covered dividends, which is a good sign for anybody who's considering investing in this type of company. So if we're looking for a large cap company that pays a bit over a 3% dividend yield, and a company that has some potential upside based on discounted cash flow, this could be a good one to consider. Okay, next up, we've got a utility company, and that is Consolidated Edison, ticker symbol ED. So Consolidated Edison, or Con Ed for short, Con Ed is a utility company that distributes electricity around the New York area. They serve about 3 million customers, and they cover a handful of states, New York, New Jersey, Pennsylvania, Connecticut, areas like that. And then when we jump over to our fair value tab on the website, well, we can see that we actually get a warning. And that is because with regulated utilities, discounted cash flow is actually not the best valuation method to use. The majority of Wall Street analysts use a standard price to earnings multiple when it comes to trying to come up with a fair value for a regulated utility. So when we jump over to the multiples tab, well, now we can see the historical average for Con Ed going back the past 10 years. Here, the purple line measures what the price to earnings multiple has been going back the past 10 years. Ideally, we want the most recent purple line to be below the averages. We can see when we mouse over on this chart here, well, we can see that the most recent PE multiple is about 17.5x. Well, using the 5, 10, 20-year averages, well, we can see the 20-year average actually gives us a fair value of about $108 per share. Out of all these numbers, that's the most conservative number. So for me, that's the one I'm going to stick with. That 108 is about 17% higher than the current price. Okay, that being said, now let's jump over and look at the dividend history to see exactly what Con Ed has done. And we can see Con Ed has, again, gradually increased their dividend over the past decade or so. They pay a quarterly dividend 4 times a year, and their dividend yield is about 3.5%. And then when we jump over to net income coverage to see how well profits cover their dividends, we can see, although they're a bit volatile, they do cover their dividends a decent amount, at least over the past decade, which is a good sign for us. Now, for anybody interested in this type of company, oftentimes utility stocks are considered to be defensive companies. So if you think the stock market might be a bit too high, perhaps a company like Consolidated Edison could be a good company to consider. If not, here's another company that we've got in the healthcare sector, and that is AbbVie, ticker symbol ABBV. So AbbVie develops, manufactures, and sells pharmaceutical drugs around the world. Their biggest drug is known as Humira. This is an injection for autoimmune diseases. But when we jump over to their segment tab on the website, we can see that they actually have a ton of different drugs. But as you might have guessed from the chart, The largest segment, the one 27%, is the Humira drug. But besides that, they have a decent amount of other drugs out there. So now when we jump over and look at the fair value of AbbVie stock using discounted free cash flow, well, we can see we get a fair value of about $190 per share. Right now, the stock's trading at about $155 per share. So overall, we can see this stock has about an 18, 19, 20% upside. So this, if we're after capital gains, this could be an interesting one to consider. But when we jump over to their dividend stock, well, we can see, not their dividend stock, their dividend history, well, we can see their dividend history is looking quite good. So we can see, like a lot of the companies we've covered so far, they pay a quarterly dividend. That dividend has consistently increased over the past decade or so. Now, when we jump over and look at their net income coverage, this is actually the weakest one out of all 5 companies we have. Generally speaking, it's mostly positive, although it's a little more volatile than I would typically like. So we also go over and we check cash flow from operations. How much does that cover it? You can see that more than covers it. Free cash flow. How much does free cash flow cover the dividends? Again, more than covers the amount of dividends that the company's paying out. So AbbVie's yield is about 4%. So if what you're after is a larger pharmaceutical company for your portfolio that pays a decent dividend, this could be a good one to consider. But if you're looking for something that has a bit more of a dividend yield to it, well, now we're going to jump over to a company that is traded on the Toronto Exchange, and that is Enbridge, which is a pipeline company, one of the biggest pipeline companies in North America. So Enbridge is a midstream company in the oil and gas sector. Basically, where you have a company like Exxon Mobile pulling oil and gas out of the ground, Enbridge is the company that will move it. They have one of the biggest pipeline networks in North America, moving oil, gas, chemicals, things like that. So when we jump over to the fair value tab and look at discounted cash flow for Enbridge, well, we can see that the stock is slightly undervalued. Right now, we're getting a margin of safety about 5%. Fair value is coming in at $52 per share, and the current price is a bit under 50. So just a little bit of upside. But when we jump over to their dividend history, well, we can see that their dividend yield is a bit over 7%. So we get a smaller margin of safety from a capital gains perspective, but a bigger dividend yield. And once again, we can see that the dividend history has been fairly good. They pay out a quarterly dividend, and they've consistently increased it over the past decade. When we jump over to their net income coverage, well, it's not perfect, but it's decent. Broadly speaking, they do a good job of paying out their dividend, of covering their dividends. But one of the unique parts of a company like Enbridge is that they pay out much higher dividend yields because they get tax advantages for paying out the dividend, a higher dividend yield. Basically, you have to pay out more of their profits, which is how you can end up with net income coverage that is fairly low like this. Okay, now let's jump over to our highest dividend yielding company, and that is a business development company called the Goldman Sachs BDC company, ticker symbol GSBD. So this company is a business development company. A business development company is kind of like a bank. This is a company that lends money to smaller, let's call them middle market companies. But oftentimes they pay a very big dividend. But when it comes to coming up with a fair value for a business development company, generally we want to value them just like we would a bank. We don't want to use discounted cash flow. Instead, we want to jump over to our multiples tab here. And on the multiples tab, we want to use price to book value. Price to book value is the best way to value a business development company, a bank, an insurance company. Any business whose product is money, price to book value is generally the best valuation method to use. And as we can see when we mouse over this chart here, well, the price to book value is about 1x right now. When we look at the table, we can see that the short-term averages, the 5 and 10-year averages for price to book, well, the fair value would be about $16 per share. Using the longer-term averages, the fair value would be about $15 per share. The stock is currently trading a bit over $15 per share. So let's call a spade a spade. This stock is about fairly valued. But now when we jump over to their dividend history and we take a peek at what their dividend is, well, we can see that the dividend for this stock is trading, the dividend yield is about 12%, a bit under 12%. And impressively, the dividend has been incredibly consistent for the past 8 or so years. And then when we jump over to the net income coverage to see if this very consistent dividend is covered, well, we can see that broadly speaking, they do a pretty good job of covering. So if a higher dividend yield, again, 11.87%, if a higher dividend yield is what we're after, this could be an interesting one to consider. Plus, this is a fairly unique type of investment. And this is an investment that will give you exposure to a lot of different investments that a lot of people wouldn't have. Middle market bonds are somewhat unusual. That's where these guys make a lot of their money. So, this could be an interesting one for a lot of different portfolios if a higher dividend yield is, in fact, what you're after. So, let me know in the comments below if you have any other dividend stocks that you think would be interesting outside of the 5 that we've presented here. And if you want to get access to the website that we've been using throughout this video, I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.